Will mortgage rates finally drop, or are we stuck with high housing costs and even higher interest rates? Let's break down what the Fed just said and what it means for you. Hey everyone, Dan Friel here with Friel Mortgage, where we help you make smart, confident real estate moves. The Federal Reserve just held a major meeting, and the decisions they made and didn't make directly affect mortgage rates, home prices, and how easy or hard it is going to be to buy or refinance in 2025. So let's break it all down, plain and simple. So first off, the Fed did not cut interest rates at their latest meeting. That might sound like no news, but actually this is a really important one. They also released their updated economic forecasts, and it's not looking great. So here's what to expect now. GDP, which is economic growth, will slow from 2.1% to 1.7% in 2025. So not great. Unemployment is expected to go up as well. And inflation, it's also going up, not down. That means the economy is projected to weaken, but prices are still rising. So not a great combo, especially for everyone trying to buy a home. Now, how does this affect mortgage rates? Mortgage rates are tied to a lot of things, but the Fed's interest rate policy is one of the biggest ones. If the Fed keeps rates higher for longer, mortgage rates stay elevated too. And despite worse economic outlook, the Fed is sticking with its projection of only 2 rate cuts in 2025, the same as way back in December. So even though they now expect weaker growth and higher unemployment, they're saying we're not changing course just yet. And why? Because inflation, especially core inflation, is still too high. It was 2.6% and now projected to be 2.8% by year's end. And the Fed's long-term goal is that 2%, like always. So until they see inflation coming down clearly, they're not going to rush to cut rates. Let's talk when the Fed may make a move. According to the CME FedWatch tool, before this meeting, there was only a 14% chance of a rate cut in May. Now that's increased to a 22.6% chance. And for the June meeting, there's now a 66% chance of a rate cut by then. So the market still believes the first cut is coming this summer and the second one sometime after that. And the biggest thing to remember, mortgage rates are priced off of expectation, not exactly what they're doing now. So if the rate cuts are in June, expect rates to come down about a month beforehand in expectation. And once they announce their rate cuts, they'll probably level off and may bounce up a little bit if it's anything like last September. So what does this mean for you? For home buyers, mortgage rates are likely to stay higher for a little while longer. So if you're waiting for rates to drop before buying, that might not happen anytime soon. And home prices aren't likely to drop drastically either, while supply is still low. For home sellers, rates staying higher can mean fewer buyers, but less inventory, so prices may stabilize or continue a modest growth depending on your current local market. Now for people looking to refinance, unless you're sitting at a very high interest rate, so 7% and above, it might not be time to refinance just yet. But if the Fed starts cutting rates mid-year, we could see better opportunities in the second half of 2025. So Jerome Powell, the Fed chair, emphasized one word over and over: uncertainty. He basically said, we don't have the confidence in our forecasts, but we're confident we can act quickly if needed. They're waiting for more clarity before making big moves. And yes, they're blaming tariffs for the delay in progress on inflation. Now, will a recession force the Fed's hand for help? Powell says there's always about 1 in 4 chance of a recession in the next 12 months. That's a 25% chance. And yes, that risk has ticked up slightly. If we do hit a recession, expect the Fed to cut rates faster. That could mean mortgage rates could come down, but also mean job losses, tighter lending standards. So it's a mixed bag. What about the stock market? The Fed won't jump in to save the markets unless volatility causes real economic damage, like hurting consumer spending or business investment. So short-term dips, they're not changing anything for that. They're only going to be like a Hail Mary. So to wrap it up, the Fed is walking a tightrope, balancing inflation, job losses, and economic slowdown. Mortgage rates will likely remain elevated until at least summer, and if inflation doesn't budge, the Fed may delay cuts even longer. But if unemployment spikes or the economy falters, rate cuts could come quite a bit quicker. So if you're buying, selling, or considering a refinance, reach out to me anytime. I'll help you navigate this market and make sure that those options make a difference for you and your family. I'll see you in the next one.